What in the stock market crash just happened today? Because everything, every single gain that the market kind of rallied yesterday after Jerome Powell confirmed that he's going to increase interest rate to 0.5%, everything the market gained yesterday, it's now evaporated. It's now gone, and even more a little bit on top of it, because the Nasdaq is down 5%, folks. 5%. I mean, look at this. Look at this. Nasdaq down 5% on the day. Dow Jones down 1,000 points today. S&P 500 3.5%. Russell 2000 for small caps 4.04%. So what is happening? What changed between yesterday and today? Because to me it seems as exactly the same reason why the market jumped yesterday is kind of the exact same reason why the market it's now down. Look, we had this massive run up at the minute we heard around about news on inflation. I mean, interest rate rising to 0.5%, and today, boom. So what is happening? Let me share with you my views on what is behind this massive sell-off that we're seeing today, and potentially look into why this may be the end or not, and personally where I see this market going in the foreseeable future. At least till the next 4 to 6 weeks, all right? Because as I mentioned, yesterday we had a huge run up, but before yesterday and today, nothing changed. And if you look at the futures, after hours yesterday and pre-market today, everything was kind of flat until maybe 6 a.m. this morning when things started to kind of cripple, 100 points, 200, 250, 300, and then it felt like a panic sell, because you can see here, this straight line is literally like a panic sell, especially if I look at the VIX, the fear index. It gained 23% today. At some point, it was up 28%. That to me tells me that, hey, there is this panic sell-off. So the panic sell-off may be triggered by algorithm, because in this current market, computers are trading against other computers, all right? And that is precisely because when you look at what interest rates are doing, if you jump into interest rate now, the 10-year treasury yield, it's now above 3%. Same thing for Italy. So look at Germany, Spain, and the UK. They are way below what the US are. And this to me is the main reason, because whenever interest rates are this high, especially on the 10-year treasury, it means people can have the ability to park the money at 3% rate, with the money being technically safe. And when the stock market is behaving the way it is behaving today, it doesn't really give people or investors a sense of stability, a sense of certainty, a sense of, direction into where are we headed next. Because even though we know that interests are going to be increasing to 0.5%, I think the biggest question now is people now realize that, oh, wait a minute, if the Federal Reserve is increasing interest rate by 0.5%, what does it mean for me? What does it mean for my stocks? What does it mean for, my debt? What does it mean for my mortgage? What does it mean for the credit cards payment that I need to do? What does it mean for the housing market? So everything now starting to kind of cripple down, because everything is kind of pointing towards the fact that there might be a recession coming up. But the thing is, a recession is not a bad thing necessarily, because we knew getting out of 2021 that type of growth was not sustainable. At some point, the economy has to slow down. Prices going up, inflation being sticky, at some point, it has to go down. But I think people are kind of freaking out now, because Europe is already kind of telling hey, consumers, you need to stop spending a lot of money, because we are pretty much going to already into a stagflation, meaning the economy is not either slowing or growing, all right? And that is not a good news, all right? Now, with China lockdowns, it also means that, well, supply chain issues may be easing, but what that means is also slowing growth in China, and China has always been seen as the engine of the global economic growth because that is where pretty much everything is being manufactured. All right. I mean, even for big companies. So if China is still in lockdown, this means they're going to be way less iPhone to be manufactured. It's going to be way less, Neo cars or Tesla cars or cars to be manufactured or electronics or clothing or whatever, furniture. Everything is going to be slowing down. All right, so right now this is kind of what people are focusing on, and this is pushing interest rate to go high. And whenever interest rate go high, these computers, this algorithm on the big banks, the big boys with the big pockets on the Wall Street, these are the guys kind of triggering this because these are kind of coded. If this goes by this percentage, then do this, because the interest rate the yield on the treasury is already past 3%. People are kind of worrying that, hey, we might go into a slowing economy. But this was not a myth, and it's not necessarily bad, So that is, to me, what is the reason behind this whole thing. Now, where do we go from here? Is this the bottom? Well, you can't really tell where the bottom is because since the beginning of this year, the markets have been really choppy. I mean, in April, we thought when we were getting into the war, with Ukraine and so this is year to date. All right, let's go to the year to date. So here, boom, we had a massive sell-off, massive sell-off. This is the S&P 500 I'm showing. Massive sell-off here in January, and we lost almost 10% just for the month of January, all right? And then getting out of there, we thought this was the bottom. But boom, coming into March, we had, conflict in Ukraine. We thought it was the bottom, and then something seemed like a rally of 11%, but since then, that was April, we had the worst month of April since the 70s. And since then, we are kind of in this descending mode, downtrend mode, going even lower to where we thought the bottom was. So to me, it's kind of hard to say, but there are some reasons I believe the bottom may be nearing. Why? Because if the main thing people are concerned about, the commonality, the common thing with everything here has to do with inflation, all right? But inflation, even though it's been sticky, it's been high since this last month, it's not gonna last ever. Why? Because the fact that China is still locking down and factories are down, it's a good thing because it's going to push, people to stop spending. All right. Now, another thing is when you look at this, big economists, they are kind of thinking that inflation will fall soon. The economy could be past peak inflation interest rate as some supply chain constraints have eased and demand has declined, said Rick Reeder, Chief Investment Officer of the Global Fixed Income at BlackRock. BlackRock is kind of that big company, so big that some people think they are really the one ruling the world. All right. Now, throughout the pandemic, this is the rationale behind it. Throughout the pandemic, strong disposable income and limited services spending fueled consumer spending on goods, and high goods volumes created bottlenecks and extreme inflation. He wrote on Twitter on May 2, eventually excessively easy monetary policy caused this robust inflation to broaden into less disrupted categories. Both the CPI, Core Consumer Index, and personal consumption expenditure will exclude food and energy inflation peaked in March and February and should move appreciably lower by the end of 2022. This is the tweet in question. So what he's saying, in other words, is, and this is what I think to believe, as we move into the end of this year or the latter part of this year, everything that caused inflation last year it's not going to be easy. It's going to be smoothing. It's going to be kind of balanced. And because of that, it's going to provide some relief into, this inflation slowing down. And when inflation slows down, it's going to actually put the Federal Reserve to be less aggressive, less hawkish, less aggressive into increasing interest rate, because whenever interest rate increase, it's not good for the economy, because it means that the economies or the companies that are part of the stock market are going to potentially slow down their investments, because they need capital, and usually capital comes from borrowing money. But if the cost of borrowing money is higher, it's getting a lot more expensive because of interest rates also getting expensive, it means companies may not start hiring, or companies may stop hiring. But in this current economy, we have 11 million opening jobs. So it's kind of mismatch in this current economy. So that's why I think until we see the next meeting from the Fed in June, all right, when we have initially the two highest increase rates for the following of this year, 50 basis points or 0.5%, then I believe by then the market will have time to digest and to see, also based on the next two CPI data, consumer price index, to kind of point towards the fact that where are we staying in terms of inflation. Then maybe people are going to be more comfortable putting their money to work into the stock market again. But until then, things are going to be very, very, very choppy, I'm afraid. But that it's not the time to get out of stocks if you own the right ones. We're going to talk about that in deep in the next video coming up later today.